crisis that we're in. And I wanted you to explain to everyone what is happening in the pension realm. Can you give everyone a little background and a little summary of what is happening in that area?
Yeah, well, you see, the issue is as long as we had a good growing, cheap growing energy and good growing economy, we could have pension plans. We can have Social Security. We can have all these things. But as the energy return on investment started to really fall, we had to use a lot of debt. It's become a lot more difficult to maintain that system. And now we hear about pension plans that are severely underfunded. And it's just a matter of time. And the worst thing is the pension plans need to get like a 7-8% annual return. That's what they need to continue paying their pensioners. Well, there's really no good assets out there. Of course, you can't put it in the bank. You're getting a fraction. And so what they're going after is very high risk assets, or very, very high risk investments like the subprime auto. You know, they're packaging subprime auto. People really can't make their payments. They're barely making their payments. And so they package these things, they high risk, high rates of interest, and they sell them off, and then pensioners buy them. And from an article I read, I believe several months ago, several pension plans were also buying risky shale oil and gas assets. So that's a problem. Now, when the pension plans really start to fall apart, Dave, so will the U.S. retirement market. It's not that far behind. And in a recent article, which I talked about, the U.S. retirement market is in big trouble. We have a new record U.S. retirement market. It hit 25.3 trillion at the end of last year. Now this is all inflated, and it really jumped up after QE3 started in 2012. I think the U.S. retirement market jumped up from like 20 to 22.5 trillion in just those few years when they were pumping the money into the QE3. Now, the issue is that works fine. They'll continue to pump money in there, and they'll continue to inflate the market. But according to new data out by the Investment Company Institute, interesting, their last year of recording this information was in 2014, and this was mostly 401ks. They call them the private DC plans, defined contribution plans. Well, in 2014, total contributions, pay-ins, were like $374 billion, but net benefits paid were $403 billion. So there was like $28 billion more paid out in 2013. That was a record. So more going out than coming in. This is the beginning stage of a typical Ponzi scheme. So the interesting thing for your listeners and readers to understand is that banks today, as well as retirement markets and pension plans, they're not really banks. A bank used to be a bank years ago when they used to have gold, and then they would loan out gold certificates. And if they loaned out too many, and then there was a bank run, people would come back and then the gold wasn't there. They didn't have the money, and that was the issue. Well, then we had a certain amount of cash. Federal Reserve fiat notes, we had a certain amount in the bank, just in case more people wanted the cash. Well, that amount has gone to nothing. It's a fraction. So when you go to a bank today and you want to get $2,000 in cash, they look at you like you're a drug dealer or something. There's something wrong with you taking $2,000 in cash because they don't even have the cash. So the problem is the pension system and the retirement market, there's nothing in there. There's no big bank. There's no big gold at the end of the rainbow. It's all debt. So when you drive around and you see all these new banks that are coming up or being built, or banks do not have assets. Banks now hold debts. That's what a bank is. It's really nothing. It's a big hole. So the retirement market, when the pension plans really start to get in trouble over the next several years, then we're going to see big trouble in the retirement market. And I look forward to seeing what the data is for 2015 and 2015 when the information comes out. But in 2014, the U.S. market was doing pretty good, so I don't know why there was a net withdrawal. And this is just going to be more bad news going forward.
When this starts to fall apart, I mean, is this just a local type of problem? I mean, we heard Dallas, they're having a pension problem. South Carolina, they're having a pension problem. Is this just a localized problem, or is this countrywide?
I would imagine some states are probably a little more fiscal responsible and aren't as leveraged as others, but those are probably in the minority. So the overall system, this falling energy return on investment is really gutting the entire system. And where it's gutting it the most now is we can't afford to continue rebuilding, maintaining our infrastructure, so we let that go. We don't even have the cash to do that. Really, the energy, which is the money to do that. And now what's also starting to happen is standard of livings are falling. Everything costs more. Healthcare costs more. And so healthcare, even though there's corruption in the industry as well as the insurance companies, yes, there's corruption going on, but the reason why things are becoming more expensive, it's the falling energy return on investment. Same thing in the pension system. So no, Dave, it's just not Texas. The CalPERS in California, they're going to be in big trouble. We know Chicago is a huge mess. Illinois is in big trouble. The whole Northeast is in big trouble because what you have there, you see, the producers, people need to realize the country doesn't need the city. The city needs the country because the food, the meat, even a lot of the, let's say, minerals and oil comes from the country, more of the country. Well, the city needs those resources. Well, a farmer who is producing a lot of wheat or corn or cows or for meat, he could still supply his family. He could still supply his family even if he lost the income from a collapsing system. So the problem is the pension plans and the retirement market in the city is the most vulnerable in the huge cities. People in the country will be hurt, but not as bad as the big cities. So this is a countrywide problem.
So as people hear this, is there any way for them to protect themselves, or is there any way to help them through this? Because what you're saying is that the funds that they were expecting to receive might not be there. And if many of these people don't receive these funds, what do they do? Is there anything they can do in the meantime to, help them out?
Well, I've been a broken record about this, and in my analysis, Dave, of the energy and the markets and the precious metals and the mining industry, the underlying factor is the energy. You can't have a housing market without energy. Forget healthcare without energy, or the auto industry. Unfortunately, analysts look at these sectors as they're different. Yes, they are. They all do different things. But without the energy sector, which is oil and gas and other energy sources, coal, etc., the whole system falls apart. Now, the thing is, this is the reason why the precious metals are really a good store of value. Of course, there's no guarantee what their value will be when the system starts to unravel and fall apart. But we have to look at it this way. If you have to put money somewhere, your funds somewhere, it's in a better guarantee than the worst guarantee or no guarantee. And the difference between gold and silver, when you have a silver coin in your pocket, let's say it's about $20, it's worth $20. Someone owes you a good or service to take that silver coin from you. So it's stored economic energy. Most stocks, bonds, real estate, the pension, and the retirement market is an energy IOU. Energy has to be burned next year and the year after to continue to have those assets to have value. And so those are energy IOUs. And when energy becomes problematic or the market really starts to fall apart due to the energy, then those values are going to implode. So that's the reason why logic suggests it's better to be in physical gold and silver that have been the store of value and economic energy for thousands of years. Even though Americans have gotten amnesia of gold and silver, the U.S. dollar was backed by gold up till 1971. And what's interesting, let me add this: since 1971, Dave, our trade deficits we went into trade deficits in 72 or 73. I think 1 year we went to a surplus again. But our trade deficits have been getting worse every year. If you add them all up, they're 10.4 trillion. That's what our cumulative trade deficit is. Half of that is oil. So without that 5 trillion that we have borrowed from the Middle East and other oil exporting countries, we couldn't have produced a lot of economic activity in the United States. So, the gold, since gold was taken off the gold standard in 1971, off the U.S. dollar peg, we've been living on a lot of borrowed time. But the Pied Piper is now is coming to call, because this leverage and debt in the system is really starting to pile up. And we're starting to see it now in many different facets. And this pension plan and the exploding cost of the health care is just one area of that.
You know, you mentioned gold and silver and how the American people have amnesia. I think actually people have been brainwashed into thinking that gold and silver is not actually a store of wealth or money, and people are very hesitant in going out and purchasing gold and silver, because at a time people said, you know, gold and silver was going to go up, it was going to increase in value, and lately we've been seeing it come down. Yes, it moves up a little bit, but a lot of people say, well, wait a minute, why would I go out and buy gold and silver if silver was at one time, you know, $40, $30, now it's $17 or $18, and gold was at 19 at one point, and it's come down to 12 or so. And I think a lot of people look at this and say, you know something, maybe I'll just stay away from it for a while, because I don't know if it's going to continually drop. What do you say to those people that look at it in that fashion?
That's a logical way to look at it, and you know they're correct. I've always stated, and I would say more recently in the last three years or so. But I think the issue is, if you're going to invest in a 401k, gosh, you do it for 20, 30 years. You do it for 20, 30 years. And if people had purchased precious metals for 20, 30 years, it would have cost them a little bit more, sure, during 2012 and 13. But then it fell, 11 and 12, and then it fell in 2013, 14, and 15. So if you kind of average it in, you're paying, you look at over a couple of decades, it's increasing, but so is all other costs are increasing. So are the prices of things increasing. But if we look at it in a few years, yes, the price of silver was 40. It hit at 49. But I think the more interesting or the more important thing to look at is that, there isn't much gold and silver out there. And the reason why the price of gold and silver, when they were reaching that, let's say silver hit 49 in May 2000 or April 2011, and gold hit, I think, 1900 in September 2011. When they hit those highs, they were starting to reach they were going towards their store value. Right now, they're being priced on what's known as commodity pricing mechanism, which is their cost of production. Based on the primary silver miner, Dave, it costs between $15 and $18 to produce an ounce of primary silver, and then it takes about $1,100 plus or minus to produce an ounce of gold. So there we have it. We're getting close. The market price is somewhat close around its cost of production. But you see, a lot of gold and silver is not consumed, like oil, gas, coal, wheat, corn, even copper. A lot of those are eaten, they're consumed, they're burned forever. But a lot of gold and silver is stored. So it has a different pricing mechanism, a different value mechanism. But since 1971, the market has funneled the world's funds, especially Americans' funds, away from gold and silver and more towards the stocks, bonds, and real estate. And so stock brokers, they get money on a percentage of their broker's commission. If they get somebody in gold, they don't make any money. So it's not in the best interest for a broker to advise gold. And you hear this across the board in the whole investment community. So yes, Americans, unfortunately, have been misled by their financial analyst. They should at least have 10%. Even if the U.S. market investors got 5% or 2% in precious metals, it would totally destroy the market. The price of the metals would skyrocket, because only 1% are investors are in gold and silver. So if you had a safe 10%, I'm not talking fully invested in gold and silver, we would see the prices really skyrocket. So unfortunately, when the things do fall apart, Dave, there isn't going to be enough metal to go around. And so that's how I look at it. It's going to be there's going to be 100 people with one chair. the musical chairs. Instead of being 9 people with 10 chairs, or 10 people with 9 chairs, it's going to be 100 people with 1 chair. So that's the unfortunate thing. Americans have not been properly educated of what is going to be a really good asset to own in the future.
So when you're saying this, those people who are out of the market, who don't have gold and silver, when this starts to happen, I'm assuming the price of gold and silver is going to move up and it's going to become expensive for individuals to acquire it. And they, at this point, I mean, are you seeing silver and gold moving up quite dramatically when everything starts to implode?
Well, that already took place. We had a great example of that in the beginning of 2016. The stock market, the Dow Jones, fell 2,000 points in just a few months, and we had record gold ETF flows. We had record retail folks going into gold ETFs, not just the physical metal, but into gold ETFs. And so that's on a 2,000 point drop. I think it was 18,000, it fell, or 17,000. It fell in the 15,000 range. Just a 2,000 point drop. We had record inflows of investors into the gold ETFs. So what happens when the thing really starts to fall apart? Because we have to remember in 2007 to 2009, the Dow Jones fell 50%. I remember Jim Cramer screaming, on CNBC that it was I think Dow Jones was at 6,600. And he said, sell. It was, he didn't see the end in sight. Well, it finally bottomed. They came in and propped the market up. Well, we're at 20,000. If we lose 50%, it's going to be more than that when the thing falls apart. That's 10,000 points. So yes, I think the next time around, when they can no longer, they will continue to prop up the markets, and they can continue to prop it up for a little while, but gravity they'll still have to come to the forces of gravity, and when it really cracks this next time. When we saw record inflows into gold ETFs on a 2,000 point correction, what happens when it's like 50%, 25%, then 50%? So yes, this is going to push the value of gold and silver up, and I think we're going to be in a whole different market at that time.
Now, back in 2008, you saw the economy falling apart. You were looking at certain signs of what was happening. When you look at the economy today, what signs are flashing at you that something is wrong and things are rapidly deteriorating?
Well, we've got several things. You look at the automobile industry. It's topping now. It wasn't as bad in 2007 and 2008 as it is now. It's much worse now. What they were doing with the housing market by putting subprime people in homes, subprime mortgages, they're doing now with the automobile industry. And so we have that factor. We also now have the highest median-priced homes in the United States. It's the highest average. And so we're starting to see those indicators of insanity, and they're doing a lot to get people in homes and in cars that really shouldn't be in there. Over the past 3 years, the earnings of the S&P and Dow Jones have been about the same, maybe even a little less, but their share, the stock indexes have exploded. That's all hot air. That's all extremely hot air, and that's not going to last. And then the underlying factor, which is the energy. We have to remember when we went to zero interest rates in 2007 and 2008, and then we did the massive money printing, that allowed unconventional shale oil production to come online. And then we had, what did that do? That pushed the price of oil to 100. And so we could bring on this inferior, low quality shale oil production. And we're still producing a lot of it. But I've got this chart in front of me. The top 12 U.S. Shale oil and gas companies, their free cash flow, when you add them all up together, their free cash flow has been negative since 2009. And it's gotten worse since 2016. So what that means, they're paying more in capital to drill than they're getting in their operating cash. That's not a sustainable business model. That wasn't a factor in 2005 or 6 or 7. The companies were making money back then in the oil industry. Now they're not making the money. And let me tell you this, in 2008, the top U.S. oil and gas companies, They had 163 billion in operating income. They made a lot of money. Last year, they lost 19 billion. Now, why is that a major factor? They had to pay 6.7 billion in their interest on debt. Forget paying the debt down. They had to pay a $6.7 billion interest payment. Now, when you lost 19 billion from your operating income, you don't have the money to pay your interest payment. So you have to either issue stock, you have to have more borrowing money, or you sell an asset. That's how you do this. Now, let me explain this further. The top three U.S. oil companies, their long-term debt has doubled in just 3 years from 48 billion to 2016 billion. This is ExxonMobil, Chevron, and ConocoPhillips. This is what's the amazing thing. When you add what they paid in their capital expenditures last year and you add what they paid out in their dividends, they were nearly 30 billion in the hole. That's why their debt is increasing. They're borrowing money to pay dividends. Why? Because if I'm going to be in an ExxonMobil share stock, I'm in there because I'm getting a 7% yield. That's where they're getting the yield from, the dividend. Well, why? Now they're borrowing money to pay dividends. They weren't doing that in 2005, 2006, 2007, 2008. So not only is the indicators in the economic indicators in the market topping out, where it's insanity going on there, the energy which runs everything is in much worse shape than it was before 2008. So when you put these both together, the system is going to limp along a little further. But when it does crack, Dave, it's going to make 2008 look like a walk in the park.
Do you think the energy sector, do you think this time that's what's going to bring down the economy?
Well, I've said this before. When you're sick, you're so sick, you say, God, I don't have the energy. You get out of bed. You don't go to work. You don't earn a living that day. Well, if you don't have the gas in your car, you don't drive to work. And if the manufacturing plant doesn't have the energy to do the manufacturing, it doesn't work. So the energy is the factor. And now what's happened is this falling energy return on investment is making the whole system grind to a halt. And now what you do to offset that is you add debt. And then we're seeing debt everywhere. It's not just the oil companies adding a lot of debt. A massive amount of debt. It's also the public government pension systems. It's also the public debt is now 20 trillion. And now we're going to have trouble now with the debt limit here in the next month or two. So the debt is exploding everywhere to try to offset this falling energy return on investment. Now, when I look at these energy companies and I see what's happening to their balance sheets, their financials, that's giving me an indicator that things are in very bad shape. So I don't forecast what's going to happen next quarter. Like a lot of the energy analysts, they'll forecast what's going to happen next quarter or next year. But the trend is the situation is becoming more dire, especially for the energy industry. And let me tell you, it's just not the U.S. Saudi Arabia is in such bad shape. They've sold 34% of their foreign exchange reserves, and most of those are U.S. Treasuries. Since the price of oil fell below $100 in August 2014, they've liquidated 34% of their foreign exchange reserve. And now in the last 2 months, the price of oil has kind of gone up. Well, in January, they liquidated $12.5 billion, and then last month they liquidated almost another $10 billion, which means Saudi Arabia is not making enough money now in their oil revenues to cover their system as well as their national economy, because Saudi Aramco supports the national government. So, and Pemex, I'll give you another example. Pemex is the Mexican state-run oil company. They're technically bankrupt. They said they're going to lay off 50,000 employees last year over a period of time. And they're technically bankrupt because they have like 172 billion in liabilities and they only have 107 billion in assets. Their oil production has fallen 35% since 2005. So, and now because of their debt is increasing, their debt is exploding too. They're finding it hard to get their debt refinanced. Countries now are no longer willing to refinance their debt because they know they're in big trouble. So when you start adding all this together, the U.S. and global oil industry is in big trouble, and I will conclude with this. Venezuela supposedly has the most oil reserves on the planet, and they're eating dogs over there now. They're in hyperinflation. Their whole economy is in disarray. We could blame it on the Communist Party. We could blame it on, their inferior government. But the problem is their record oil reserves are heavy oil reserves. They're really not profitable. Believe me, if they had very cheap, light oil reserves, they would not be in the position they're in right now. But our good quality oil reserves have been severely depleted. And so this is the issue. Egypt fell apart because they became a net importer of oil. They used to be an exporter of oil, but when they became a net importer of oil, that's when we had the problems in Egypt. So one by one, the situation continues to get worse in the energy market, which translates to the overall economy.
Back in 2008, we had the subprime security, and we saw what happened to the real estate market. People were leaving their homes, and the real estate market just imploded. Now, today, in 2017, you're telling us that the oil industry is in trouble. When the oil industry implodes on itself, what happens? What are we going to see because of that occurring?
It's hard to forecast how things unfold. We could see, I do get a lot of emails, people saying that, well, why can't the U.S. government backstop the oil industry? They can. We could write off debt. They backstop they bought all the mortgage-backed securities off of the banks. So why can't they take off the debt? Well, you see, they could do that. They actually could do that. And so what would happen is things would continue a little bit longer. The problem is it's the falling profitability of the oil. You see, I think I mentioned this in several interviews. U.S. needs at least 20 profitable barrels for every barrel of energy that they put in to get those 20 profitable barrels. Now, we need 10 profitable barrels just to run the interstate highway system and to get all the food to the dinner plates of Americans and to restaurants. We need that. We need those 10 barrels for just to run that system. We don't have that, then we can't run that system. And then if you want to add the entertainment, education, healthcare, the military, if you want to start adding all that, then you need more profitable barrels of oil. Well, shale oil is 5-to-1 profitable barrels. So we're not maintaining this situation. We're not maintaining it. Now, what's helping us is we're importing oil from other countries that is higher. So it's kind of averaging out to be higher, but it's still a deficit, which is why we're seeing all the debts now in the U.S., in the public as well as private debt increasing. So, but when the energy market really starts to fall apart, we're going to see massive bankruptcies. Yet, why would another company go, okay, I can go in and buy their assets up for nothing? Because it wasn't profitable to drill shale oil at 100. Why? Why would you buy up the property and go and on pennies on the dollar and try to produce it now when the price of oil is half? And I don't really see the price of oil really increasing unless we have hyperinflation. So when the energy market really starts to unravel, then we're going to see the just-in-time inventory system in the U.S. fall apart. And I believe you had Alice Friedman on, and she talked about her book, what happens when trucks stop running.
Yes.
And when trucks stop running, a lot of things don't happen. And where I live, a lot of the coal that we use to burn in coal-fired power plants is transported by truck. They need diesel to transport the coal that gives us electricity for our homes and businesses. So I think when this thing really starts to fall apart, it could get very ugly, Dave. And I'm not wishing for that. I wish there was another all-energy solution, but there isn't any really good energy solution. So I think what's going to happen, we'll see a collapse, and then we'll try to work our way through it by moving to more regional and local business activity. That's how I see it. The world will just become a bigger place.
Yeah, so this sounds like it's really a terrible situation. I mean, from what you're saying and what you're looking at right now with oil and energy not doing well at this point, it looks like if things rapidly fall apart, we're going to have major problems, because what I'm hearing is that everything is run on energy. And I mean, what about the power to the home? What about, I mean, everything that we see, it's just, I mean, is that going to just come to a screeching halt?
I don't think it'll come to a screeching halt. That probability is probably very low. But I think this is how I kind of visualize things. We're at a cliff right now. We're at a major cliff. We're going to fall off that cliff, and we're going to just fall down considerably. But then we're going to hit another cliff down that mountain or down that cliffside. We'll hit another cliff sticking out, and maybe we'll try to recover a little bit. But then as we walk out and it recovers past the edge of the cliff, we'll fall down again, and it'll be another cliff-like dive. We have to remember the Roman Empire. It also collapsed due to its falling energy return on investment. And Rome at its height had 1 million people. During its collapse, there was only 12,000 people left in the city. That's a 99% collapse of the population. Didn't happen overnight. Took time, but towards the end, it fell apart very quickly. Matter of fact, it fell apart within a few decades. So the difference between the Roman Empire and what we're looking at today, Dave, is that technology has increased things. Technology made us do things faster on the way up, and technology will allow us to collapse quicker on the way down. It's a two-edged sword. So I think what we'll see is, at some point in time, we'll see a market crash. We'll probably see bank closures. This is going to really gut the market, the economy. There are going to be millions of cars out there that they'll have no place to put them. They've got record inventory of new cars now. They're going to have used cars, which I read an article by. I believe it was, what was the bank? Morgan Stanley said they see used car prices falling 50% in the next 3-4 years. That's a bank saying that. I think it's going to be worse. I think you'll be able to buy a new car 5-10 cents on the dollar. So there'll be millions and millions of cars with nowhere to go. We're going to see home prices collapse. We're going to see economic activity collapse. And then it's going to kind of bottom for a while. That's how I see it. Oil production, the expensive oil production will fall apart. And then we'll have less oil production. And it'll never come back like it did before, like it did over the last 8-9 years. So that's how I see it. I see cliff-like declines, a stabilization for a while, and then another cliff-like decline. I think that is probably the most logical way things are going to unravel.
And where do you see the dollar going? Many people are talking about a brand new currency. What happens to the dollar during this period?
Probably the same thing as the Venezuelan bolivar. I mean, as well as most currencies. I've seen some articles and some analysis that at some point in time, I think even Jim Rickards has been talking about the dollar will become just like the Mexican peso. It's just another currency. It's no longer the reserve currency. He says that they're going to try to do a new like SDR basket thing, but that's not going to work. And I agree with him on that. So that's when, and he believes, according to his analysis, and being on an inside in the government, he sees the price of gold really surging over the next few years. So it makes logical sense. So what's going to happen with the dollar? At some point in time, it's just going to be like every other currency. And let me tell you, the Mexican peso, when the price of oil fell and their production has been declining, the Mexican peso has lost 32% of its value in 2.5 years. Now, what's interesting, when the peso loses value, when the oil price declines, the dollar goes up. You see, that shouldn't be. We're getting a benefit from the demise of other countries who are supporting us or who are actually giving us goods and services, especially oil. So we're actually benefiting from the demise of other countries and their oil revenues and et cetera. So to me, the dollar will be in bad shape. At some point in time, the dollar will start to really lose value, and I don't know how it's going to unfold, because we have a lot of digital currency. We don't have a lot of Federal Reserve notes that you can fold and put in your pocket. So it's going to be interesting, but I do know as the dollar really loses value, the metals will be the few go-to assets.
Steve, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work?
All right, Dave, if they want to check out I put out 2 or 3 articles normally a week. It's the srsrockerreport.com. We focus on the precious metals, the mining industry, the energy and the economy, and how the falling energy return on investment basically guides the whole system. And so that's what we do, and your readers or followers are more than welcome to check out any new articles we put out.
Thank you very much once again, Steve. Thank you for being on the X22 Report Spotlight.
Thanks, Dave. Look forward to it. Look forward to doing it again.
Yes, me too. Thank you.